Howdy, howdy traders. Today we have something truly exciting in store for you. We'll be sharing a trading strategy that I think you will be interested in and excited about. This particular strategy is designed to not only minimize your losses during bear markets, but also maximize your gains in bullish ones. At the end of the video, we are also sharing an additional system that will complement this one perfectly. But first, in this video, we'll be taking a closer look at the well-known Golden Cross indicator and sharing our backtesting results on the S&P 500. Before we dive in, let's take a step back and make sure we're all on the same page. What exactly is the Golden Cross indicator? The Golden Cross is a chart pattern in which a short-term moving average crosses above a long-term moving average. Typically, the Golden Cross uses the 50-day moving average as the short-term moving average and the 200-day moving average as the long-term moving average. We are going to use this in our example today. But why would you use the Golden Cross indicator? Well, the stock market tends to be in a long-term uptrend due to inflation and productivity gains, and the Golden Cross strategy aims to exploit this upward bias while reducing losses in bear markets. In fact, the Golden Cross can help you stay out of a major bear market, and while the strategy is prone to whipsaw signals, the few big winners can make up for it. So how do you use the Golden Cross indicator? The rules are simple. When the 50-day moving average crosses above the 200-day moving average, it signals a bullish breakout, and you buy. Conversely, when the 50-day moving average crosses below the 200-day moving average, it signals a bearish breakout, and you sell your position. Let's take a look at a trade example. In this example, the 50-day moving average broke above the 200-day moving average, signaling a bullish breakout. You could have bought the S&P 500 in July 2020 at 28.67 and ridden the trend until you sold in March 2022 at 41.73 for a nice 32.4% gain. Of course, not all trades turn out this well. But how does the Golden Cross strategy perform over the long term? We backtested the strategy on the S&P 500 since 1960, and you can see the full trade list here. The strategy primarily involves minimal activity, resulting in a small number of trades, specifically 32 in total. Each trade is held for approximately 350 days. We found that 78% of the trades were winners, with an average trade gain of 15.4% and an annual return of 6.6%. While this doesn't beat buy and hold's annual return of 6.9%, we have to consider that our strategy was only invested 69% of the time. However, the Golden Cross strategy had substantially lower drawdowns compared to buy and hold, with only a 33% drawdown versus buy and hold's 56%. Thus, the risk-adjusted return is better at 9.5%, which we calculated by dividing the annual return of 6.6% by the time spent in the market, 0.69. So there you have it, a powerful trading strategy that can help reduce your losses in bear markets and ride the bull markets. If you want to know the code we used for this strategy, you can find that and hundreds of more on our website. Perhaps you want even more trading and investing tips. Be sure to check out our website, quantifiedstrategies.com, where we have plenty. If you like this strategy, you will probably be as excited about this system here, our short-term NR7 strategy. Don't forget to subscribe to our channel for more trading insights and updates. Thanks for watching.